Hello, everybody, and thank you so much for joining us. My name is Emma Dukes, and I am a sales director with our international institutional team. Now, I'm sure many of you are familiar with Brown Advisory, so I'll keep my introduction short, but in brief, you may well know that we run concentrated portfolios with a long-term mindset. We underwrite all the businesses we own by deep dive fundamental due diligence. In today's session, we're going to be focusing on the financial sector, and I'm delighted to be joined by four of my colleagues in the equity research team who are tasked with identifying companies in the space. Our exposure to the financial space is notable. We own anywhere between 10 to 25% of invested capital in the sector, but our exposure goes far beyond just traditional banks. We own businesses in exchanges, insurance companies, alternative asset managers, payment providers. And these are really interesting businesses. They're bellwethers not only for consumer sentiment, but also the wider economy as a whole. A couple of points of housekeeping before we go into more detail. Please do ask questions. You can submit these via the Q&A box on your Zoom screen. And then also we are gathering feedback. So if you do have any, you'll be prompted by a pop-up once you leave the session. But now to dig into the slides. An allocation to the financial space has been compelling over the medium term. As you can see, over a 5-year period, the sector has outperformed the S&P 500 by 54%. And we certainly think a long-term allocation to the sector is warranted. These companies are central to the workings of the wider economy. And in today's session, we're going to dig into a little bit about how we select these businesses and then also recent market dynamics. But without further ado, I'd like to hand over to my colleagues to introduce themselves, starting with Frank.
Thank you, Emma. Good morning, everyone. My name is Frank O'Donnell. I'm part of the equity research team here covering financials. I've been with Brown for about 4 years. Prior to working with Brown, I spent about 6 years in Manhattan working in a similar role with an investment firm out there, where I also got my MBA out there at NYU. Here at Brown, outside of covering just the subsectors within the financials, I actually spend a decent amount of my time working with the small cap companies within financials, which is something I really enjoy. Small cap space, you have sort of the opportunity to discover some of these names that are less followed, and it can create some pretty interesting investment opportunities. So with that, I'll turn it over to Ken Coe.
Great. Thanks, Frank, and hello, everybody. Thanks for joining us today. My name is Ken Coe. I've been at Brown for about 12 years now, and I cover mid-cap and large-cap financials along with my colleagues on the screen. So, Cam, I'll pass it to you.
Yeah, great. Thanks so much again for joining us, Cam Mathis. I've been with Brown for 6 years. Prior to that, I was with Evercore in New York City. And over the past 12 years, I have covered financial services as either a buy-side investor, sell-side sort of equity research analyst, and investment banker. And with that, I'll pass it to Tommy.
Hi, everybody. Great to have you with us. Tommy Fitzalan Howard. I joined Brown in 2015, so I've been here for almost a decade now. I work on the global equity team based out of London, covering international companies, primarily within the financial market infrastructure space, but also kind of in the wider data, info, and business services space more broadly.
Great. Thanks so much, everybody. First of all, we're going to kick it over to Cam. Cam, if you could give us a little bit of information on this slide in terms of the broad underlying subsectors and recent performance dynamics in the sector.
Sure. So first, to underscore the obvious, our goal is to deliver best-in-class returns for our partners within the philosophy of a defined strategy. But with that, I'll sort of make a few comments about the financial services industry and how we consider investing in it from a few different vantage points. So first, financial services, as we define it, is the second largest industry by benchmark allocation. And that's defined as either through the S&P 500 or the Russell 3000. So that's around 15%. The industry also has a larger per company representation, sort of as a percentage of the index at close to 20%. And so there is a large hunting ground for sort of potential investments within this industry. If you draw your eyes to the top of the slide, we believe there are 5 primary subsectors within the financial services industry. So that's banks, which is about 25%. There's insurance, which is about 25%. There's capital markets, which is 20%. There's financial infrastructure, which is 10%, and then payments, which is 20%. And below that, you can see a list of select investments we have across the platform by each subsector. So that's the Bancorp, First Citizens and Banks, Insurance, Progressive, and AIG, and Arthur J. Gallagher, and so on. In capital markets, it's KKR and Ares. In financial infrastructure, that's Moody's, S&P, and payments, Visa, MasterCard, Fiserv. And our approach to investing in this sector is really based on the understanding that there are generally three types of companies within our universe, but that's probably also likely across other industries. And so first, there are secular growth companies. These are businesses with very long-term business and competitive tailwinds. So think of Visa and MasterCard as prime examples. There are cyclical secular growth businesses. So these companies still benefit from secular growth tailwinds, as discussed, but they undeniably have cyclical aspects to their businesses. So think of KKR, Moody's, Progressive as examples here. And then there are cyclical businesses. And so these are many old world financial services companies that people generally think of when they think of the industry. There are a few notable exceptions, but these are banks and insurance companies. So you can think of Bank of America and the Bancorp as examples. And with that, I think we can move to slide 3 and discuss recent performance. So the financials industry, as spoken to before, have outperformed benchmarks over the short, medium, and long term. And that was the case over the last year and a half. In 2024, financial services companies have outperformed the S&P 500 by about 600 basis points, led by some of the higher beta, pro-cyclical, sort of offensive companies in consumer finance, banks, and pockets of capital markets. These companies have benefited from the lack of a recession that was expected at the outset of the year, moderating inflation within the United States from over 3% in January to over 2.5% in September, US Fed funds rate reductions of 75 basis points, and strong market and sort of asset value performance. So the S&P 500, as you can see here, was up to 25% in 2024. And this all benefited consumer net worth gains, bank credit expense, capital markets activity. And then we must also sort of acknowledge that the US presidential sort of election brought with it substantial rises in market animal spirits related to sort of economic growth and its related benefits to all of those sort of dynamics as discussed. Some of the key outperformers were KKR, sort of Ares, First Citizens, Progressive, Fiserv, Blackstone, and Citi as select sort of portfolio holdings. And in 2025, financial services have still outperformed by the same 600 basis points, but the drivers have been considerably different so far. So within the United States, the administration has obviously sort of introduced wide-ranging trade policy changes, and the economy actually marginally shrank in 1Q25. Inflation moderation has stalled with CPI at around 2.5%, and capital markets activity has ground to a standstill. And with that, the overall market and economic uncertainty has led to market asset value declines and widening bond spreads. So we have, over the last sort of 5 months here, seen substantial outperformance of the lower beta defensive companies, such as insurance and payments, with prime examples such as Progressive, Gallagher, and AIG. And then you can also include Visa and MasterCard. Now, philosophically, as we discussed, we are fundamental bottoms-up investors and continue to have a lot of confidence in our strategy holdings across financial services. But with that, one comment I would make from a portfolio construction perspective is that we have advocated for and been able to achieve a barbell strategy within our strategies, whereby we have a core structural growth business paired with cyclical structural growth businesses that are both high beta and offensive with low beta and defensive, so that we can neutralize the unwanted factor bets or risks such as interest rates or market asset values. And then the final piece to the puzzle is We try and obviously find a truly unique business that is, undiscovered and unappreciated by the market, such as an AIG, a Fiserv, a Citi, or a Charles Schwab. So with that, I can pass it back to you, Emma.
Perfect. That's super helpful. Thank you, Cam. And now we're going to drill down into banks. Frank, obviously, a lot of the banks have been caught in the crosshairs of the year-to-date volatility, as spoken to by Cam. Maybe you could help us understand some of the performance around that.
Thank you, Emma. The banks are doing okay. Credit continues to look very good across the banks. JP Morgan, Bank of America have non-performing asset to asset ratios of just 20 basis points, which is just a really low number for this important credit metric. If you look at the chart in the top left-hand corner of the slide that's up, you can see that the industry as a whole has a non-performing asset to asset ratio of just 45 basis points, which is a benign number. During a recession, that metric will be several multiples higher. This metric has crept up over the last 2 or 3 years, as you can see in the chart, but this is really more of a normalization than anything, coming off of historically just very, very low credit metrics coming out of the post-COVID environment that was full of zero interest rates and lots of fiscal stimulus. So overall, credit though still does look pretty good. However, what we did hear unanimously across the banks with 1Q earnings is that corporates and consumers are certainly getting more and more cautious. If you look at the top right-hand corner of the slide that's up, what we've done is we've listed 4 quotes from the earnings calls in 1Q25 earnings. What we thought was interesting about these quotes is that they all say almost the same thing, almost verbatim. And that message from the banks is that corporates and consumers are financially healthy, but are in what they're calling a wait-and-see mode. That comes with obviously more cautiousness. It results in lessened consumer spending. It results in less demand for borrowing. And all of this translates to diminished and pretty muted loan growth for the banks once again in 1Q. Banks typically grow their loans highly correlated with nominal GDP. The last few years have seen that underperform. The banks have been growing loans more with a low single-digit rate as banks have tightened up their credit boxes and consumers have grown increasingly cautious. Next, what we wanted to do with the bottom 2 charts on the slide that is up is we wanted to show how some of this incremental cautiousness that we're seeing from consumers and from corporates is making it into some of the key leading economic indicators. So for instance, if you look in the bottom left-hand corner of the slide, this is a chart of the readings of consumer sentiment. And as you can see, these readings are near historic lows, again, reflecting increased cautiousness from the consumer. In the bottom right-hand corner, we have a chart of widening credit spreads, which is a reflection of increased cautiousness around corporate credit. And not only are widening credit spreads a reflection of what's going on, they're also an input. Widening credit spreads is the tightening of credit for the system, which will have an adverse effect on economic growth. It is worth noting, though, that even though we have seen credit widening, as you can see in the chart, credit spreads are still not as high as they go during recessionary times. But the move over the last just 2 months of 100 basis points for lower quality companies to get credit is notable and is certainly a credit tightening. Again, with that said, though, the banks are doing okay. They've got lots of capital. Many of them are operating at a low teens ROE. They're putting their excess capital as they earn it into the share buyback program, with many of these bank stocks trading at 10 or 11 times earnings. And so from a shareholder perspective, that can be pretty impactful and pretty attractive. So we own a number of banks that we like that fit sort of the description of some of the high quality nature of businesses that we look for. Particularly, we like Bank of America, First Citizens. I think going forward, we'll have to see how things play out. There's a lot of uncertainty around tariffs and things like that. The second quarter of earnings that we get in 2 or 3 months will be really interesting to look at coming out of the banks to see if some of these tariff policies that have now been in place for some time, as well as some of the other macro dynamics that are going on, do finally make their way into credit metrics of banks and further kind of put corporates and consumers in a bit of a cautionary mode. So we'll see how it all plays out, and I'll turn it back to you, Emma.
Thank you. Yeah, that's helpful. And you've alluded to some of these points already, but some of our clients are increasingly factoring in a recession into their sort of scenario analysis. How would the banks react in that environment? And I think, more specifically, how does this environment differ from 2008? And are there also any similarities we can see from that period?
Sure. Well, the banks are much better off today than they were going into the 2008 times. A big part of that are the implementations that have come out of the Dodd-Frank Act, which was passed, I believe it was in 2010. It's required banks to hold much more capital. They have much more liquidity as well. It's really de-risked the balance sheets in terms of loan portfolios, or simply they're making less risky loans. You see fewer levered loans, for instance, on bank balance sheets. And even the securities portfolios are very much de-risked. What you don't see that we saw around the 2008 times is sort of a levered up securities portfolio with subprime MBS and this sort of thing. Today, there's almost no subprime MBS on these bank balance sheets. It's mostly government guaranteed, high quality MBS. It's treasuries, it's high quality corporates. The result of all of this is just more sound balance sheets for the banks. This is tested and proven out really every year through the Fed's CCAR stress test process, where they kind of layer on a pretty dire economic scenario onto the bank balance sheets. And what you see is that the banks lose a couple hundred basis points of their capital base over the course of a couple years, but they maintain a well-capitalized position, and they really hold up very well. And this is important not only from an investment perspective and as you're considering downside risk to these banks, but it's important to our financial system. It's important to the economy that 15 to 16 trillion dollars of loans and deposits and just the inner workings of the economic system are much more sound today than 2008. And so, it's good to see, and I think it'll be really important going forward as we do start to see recessions in the future.
Thank you so much. We're going to turn our attention to a different sector now, payments. And Ken, we've had many investors ask about whether these businesses can continue their growth rate, considering the penetration in the space. Maybe you can talk a little bit about your conviction around these companies.
Yeah, thanks, Emma. So you're right. We do get a lot of questions about the sustainability of the growth rates at the networks. And I do think that there's probably, from an investor perspective, some underappreciation of not only the runway that they still have in kind of the core consumer payments business, which is what typically comes to mind when people think about the networks, but also too of some of the growth levers that they have outside of that core business, which we'll go into a little bit. But if you think about the core business itself, so despite the fact that you have had a massive amount of electronification of payments over the last few decades, there's still a tremendous amount of cash that's actually still, or cash and check that still hasn't been electronified, right? And if you think about it, PCE, personal consumption expenditure, is growing. If you just look at this chart on the top, it's something that grows pretty much every year. And so Visa, MasterCard, these other networks are growing their penetration into a growing market. And so a lot of people tend to think that, well, we're super penetrated in the developed markets, so really the only area for growth is in the developing markets. And what we've actually seen is that there's still quite a bit of cash and check in developed markets, right? The makeup may look a little bit different than the penetration that we're seeing in developing markets, but there's still a lot of cash and check that sits in developed markets. There's also quite a bit of cash and check that sits in developing markets. And if you think about how these companies are attacking growth, you obviously have growing PCE, which we've discussed, but they're also increasing the number of credentials worldwide. And this used to just be getting more hands or more cards into the hands of consumers that had a bank account. So traditionally speaking, banks were your issuing partners for the network, but increasingly you're seeing a lot of neobanks, a lot of digital wallets, a lot of fintechs that have become almost new age issuers that are getting cards into more hands. And particularly as we move down market into more of the unbanked and underbanked population, these are new age issuers that are getting cards into the hands of people for the first time that are now able to go out and spend money on debit or credit cards. They're expanding acceptance. So the networks are working with acquirers worldwide to not only attack that long tail of merchants that don't currently accept payments, but also make it a lot easier for just everyone to accept payments. Somebody can throw up a QR code. They can now download an app and accept payments on their phone. So they're attacking the acceptance side of the equation as well. You add to that the world is increasingly moving into the e-commerce world. And if you look at the penetration of, let's just say, Visa and MasterCard as a percentage of spend on e-commerce versus face-to-face, their penetration is much higher. So as we move into a world that's more dominated by e-commerce, the networks are going to be beneficiaries. And really the last, I guess I'd say, leg of the growth stool on the core consumer side is governments. Governments are increasingly working with these networks to drive increased penetration of electronic payments, and you're seeing that all over the world. So we still think that the core consumer payments business has a lot of growth runway. But like I said earlier, I think a lot of investors underappreciate that there are these two new growth levers that we'll dive into real quick that are actually driving a substantial amount of growth and an increasing amount of growth of these networks and ultimately over the next few years, they could occupy a very large part of the P&L for these networks. And so the first is new flows, and all the networks call this something different, but we'll just call it new flows for the sake of simplicity. But if you think about how these networks worked for the first few decades of their existence, it was money going one way, and that was money going from a consumer's credit or debit card to a merchant. And what they've done now is they've effectively said, why don't we reverse that? And why don't we make it so that, for instance, money can go from a merchant or a business right onto a consumer's debit card or right into their bank account? And so that's exactly what they've done is they've kind of taken the model and shifted it and sent it the other way. And now you have effectively, from the network perspective, the ability to send money pretty much anywhere in the world, from any endpoint to any endpoint. And so if you look at the addressable opportunity here, in a lot of cases, people think that this could be more sizable than the core consumer opportunity. And so there's a lot of acronyms on here, but if you look at just P2P, for instance, that's just person-to-person payments, right? And so that's just somebody sending money, let's just say it's through PayPal or Cash App or over a remittance app, for instance, right? So maybe it might be through Remitly, where I'm sending money internationally. B2C. So this is a business sending money to a consumer. A lot of people would think, well, what could that entail? Well, it could be an insurance company that's dispersing an insurance payout directly into your bank account or into your debit card. G2C, that's government to consumer. So think about disbursement programs, aid programs, where the government is sending, again, money directly into your bank account. On the other side of this is the world of B2B. So if you think about it, the way that the networks have kind of attacked it has been a little bit different. But the idea is that businesses need to pay other businesses. So whether that be on the account payable side, whether that be extremely large cross-border payments, these networks have attacked those addressable opportunities, and those are now becoming big growth engines for these businesses. Then lastly, if you look at value-added services, these are services that for the most part are tied to transaction activity, but there are also ancillary services. But if you just thought about it from a basic level, these are things like fraud prevention, right? It's tokenization, it's issuer processing, it's acceptance solutions, so acquiring solutions, it's advisory and consulting services. So if you look at this new flows and the value-added services, these are businesses that could be growing at 2 times what the core consumer payments business is growing. And that's what ultimately gives us a lot of confidence that this kind of high single-digit, low double-digit growth rate at the payment networks is sustainable. And obviously you couple that in with, operating margin expansion, very solid free cash generation, which, can either be used to delever, to reduce share count. And you have a very sustainable, low to mid-teens EPS growth rate at a very palatable multiple. So that's why we continue to have a lot of conviction in the payments names here. And Emma, I'll pass it back to you.
Thank you. Yeah, no, that was very clear. We're going to now dive into alternative asset managers, kind of subsector of the capital market space. Cam, this is an area you cover, and these are companies that we've seen really in focus over the sort of medium term, huge growth in assets, revenue, valuations, but some of these businesses have struggled year to date. Has a lot of this been a result of cyclical factors, or are we seeing any kind of cracks in the more secular thesis for these groups?
Yeah. So to answer the question directly, I would say that if I had to ascribe a percentage of weight to cyclical or secular drivers, I would say, in my mind, cyclical is 95% and secular is 5% of the underperformance year to date. If you speak to some other investors in the market, they might weight it to a greater degree to secular factors. But I would say at the outset of the year, there were high expectations for an opening of the capital markets, and therefore the alternative managers to finally begin returning capital to LPs after 3 or so years of trying to grow their businesses via sort of EBITDA to meet the return thresholds for their LPs. Clearly, that has not transpired. But I would say in some respects, I think it has actually benefited some of the managers that we own, such as KKR and Ares, whom have been able to still deploy capital and return capital where many others have not. And I guess bigger picture, what I would say from a growth perspective is we remain excited about the growth opportunity for the alternative managers within their core businesses, but also there are sort of growing adjacent businesses that we are very excited about. And so, I will acknowledge at the outset of this sort of point that the private equity industry is undeniably more mature today and is more accessible to the institutional investor globally versus even 5 years ago. There's clearly been slowing in the growth of this market, and that's particularly as the 2019 to 2021 vintages have across the industry generated fairly mediocre returns in sub-public market benchmark returns. But still, there are large growth opportunities. So there's growth in distribution channels, that's through sort of individuals. There's growth in geography, that's primarily within Asia. There's growth in asset classes, that's private credit for one. And you can also include infrastructure there as well. And then there are regulatory-driven growth drivers, particularly from sort of, as Frank alluded to, the Dodd-Frank Act, which is moving more traditional credit extension to the alternative managers. And this is something that the alternative managers have clearly spoken about as growth opportunities. What I would say is we have obviously had to due diligence them and determine and ascertain how tangible they are sort of as growth opportunities. And what I would say is we've been able to lean on the breadth of the platform here. We have an investigative team across the research sort of franchise, and we also have a private client team that is fairly intimately familiar with these alternative managers. 2 exercises that I would just sort of provide you with are for the distribution channel growth opportunity. So that's individuals. We have reached out to tens and tens of small RIAs, but also financial advisors at the wirehouses, potential clients, and tried to ascertain what their appetite is for some of these retail products that these alternative managers are coming to market with. And coming away from those conversations, I think we had positive data points supporting the growth opportunity there. One other project that we've also conducted is speaking to tens and tens of private businesses and trying to ascertain the sort of true value proposition of credit extension from the alternative managers and their ability to structure credit differently from a traditional bank more quickly, and deal with a singular point of sort of investor is key and critical for some of these some of these small to medium-sized businesses. And so what I would say from a bigger picture is, yeah, we're very excited still about the growth opportunity, particularly within these new channels of distribution, geography, the asset classes, and from some of the regulatory-driven sort of dynamics in the market. But there are businesses that we own, for example, like KKR, that are preparing for the eventual saturation of the alternative market. So they have pursued a balance sheet intensive strategy whereby they are acquiring and holding businesses for a long period of time, sort of in the same vein as Berkshire Hathaway. And they ultimately will be a compounding book value machine over a long period of time. And we find this opportunity to be fairly lucrative for them for a handful of different reasons over the next 5 to 7 years. And it is really starting to sort of manifest over the next 3 years in the terms of free cash flow generation. And so we are excited about these businesses still from sort of the growth sort of angle. But in addition to that, the market drawdown for some of these businesses has also provided more palatable sort of valuations relative to that growth opportunity. And when you think of these companies within the context of a portfolio and then being cyclical structural growth businesses, if we believe that a lot of the underperformance year to date is primarily due to cyclical factors, and we still believe in the structural growth opportunity, then we undeniably have to sort of believe in the sort of business outlook and see through some of the cyclical sort of headwinds these businesses are facing, and sort of stick to our knitting in the structural opportunity. So I'll leave it there, but we do like these businesses over the long term, and believe a lot of the underperformance is due to some of the cyclical sort of headwinds in the market today.
Thanks, Cam. And as a quick reminder to listeners to the call, if you've got any questions, do ping it through on the Q&A box. Before we move to that, we are going to loop in Tommy, head over to London. Tommy, you cover exchanges and infrastructure, really providing a sort of industrial backbone to a lot of the companies that we've spoken about already. These groups tend to provide a sort of different earnings stream. Maybe you can talk a little bit about that and why that's quite compelling for inclusion in the portfolio.
Yeah, thanks, Emma, and hi everyone. So I know I appreciate time, so I'll keep this brief. We want to leave some time for questions. But for us, financial market infrastructure, I think is often a bit of a forgotten or kind of overlooked part of the financial sector. Especially kind of when we think internationally, which is an area that I cover. There's a lot of very high quality and differentiated business models that are counter-cyclical in nature, but also very defensive in their top line. And we think it's very good exposure to have during times of volatility or the kind of macro uncertainty that we have at the moment. A lot of these businesses really provide the plumbing that allows financial markets to operate efficiently and effectively. They're critical infrastructure that kind of can't be substituted or replaced. And a lot of them provide mission critical benchmarking or data or analytics that, again, is very, very hard to substitute away. And these kind of characteristics lead to very strong barriers to entry and kind of dominant monopoly business models. They have strong network effects, scale advantages, switching costs for customers, and also some aspect of regulatory capture where quite often due to the risk mitigation services that they provide, despite their monopoly position, the regulator actually really rather likes them. And that's a pretty unique kind of facet to have. And they also have very attractive financial characteristics, typically 60-70% plus EBITDA margins for the core exchanges, 90% plus incremental margins, and very high returns on investor capital. So they're an area that we really like and an area that we have a number of investments in. In terms of kind of why we think these investments are interesting now, we do think, as I mentioned, that they are also very defensive. If you think of the core exchanges space, their business model is inherently counter-cyclical. During times of market volatility, market participants have an increased need or an increased desire to hedge risk, and volumes in the futures houses go up. And we see this sort of across a variety of asset classes. People hedge more, and that's good for their businesses during times of volatility and uncertainty. For the more data providing piece, they add a lot of value in terms of the data and analytics that they provide. And these are really highly recurring and subscription-like revenues. Again, customers don't cut this during kind of macro sort of uncertainty. If anything, the sort of demand for these services increases. And the final point to make is also they deliver a lot of value to the customer. the value that they deliver to the customer is far greater than the price that they charge. And I think you can see this very clearly on the example that Moody's give. The price that the customer pays is much less than the value that they're getting. And so this really allows these businesses to have a lot of very strong pricing power. And that's a huge tailwind to compounding, but it's also very defensive in times of volumes might be depressed. The allow you to sort of increase prices is a great tailwind to growth. And we've really seen these characteristics kind of come through year to date in a lot of the financial market infrastructure space. If you look at Deutsche Börse, for example, company we invest in, they own Eurex, which is the leading CCP for rates, commodities, and equity derivatives within Europe. They've seen their equity derivative contract volumes up 40% year to date. Their interest rate derivative volumes are up 18%. So again, huge growth swings that we're seeing in volumes because of the uncertainty. If you think of kind of more on the data side of things with the London Stock Exchange Group, another company that we invest in, the bottom left chart that you see here, which is this kind of the consistency of their compounding of the growth, irrespective of market environments. Again, we've really seen that year to date, with them continuing to grow mid to high single digits in their core Refinitiv business, which provides the leading financial market data to financial market participants. And again, in other areas like index providers like FTSE Russell or MSCI, they've really seen high single digit growth continue in their subscription businesses. So we really think this is a sector with businesses that have not only very good secular growth longer term, but they're very defensive on the recurring revenue data side, and they also then benefit on the cyclical side, which we're seeing at the moment from volatility and uncertainty as market participants want to hedge their risk. So they're very high quality and all-weather companies, which we think is a really good place to be at the moment, and a reason why we have a number of investments in this space.
Thank you so much, Tommy. That was very useful. We are going to open for questions now. I am going to kick it off with Charles Schwab and come back to Cam. Charles Schwab is a new investment across a few of our strategies. Wondered if you could just talk us through the investment thesis here.
Yeah. So the investment thesis begins with a new management team. There's a new CEO and new CFO. They have just recently taken charge. The new CEO is very clearly pivoting to growth after 3 years of acquisition, sort of integration of Ameritrade. They have sort of already launched a number of products like 24-hour, 5-day trading. They've leaned in on some of the active trader tools. They're leaning in on sort of international, and they even expect to launch a crypto platform in the back half of 2025 or the beginning of 2026. And so this is the first time in 3 years that they've really started to introduce new products. So the high level takeaway is they're pivoting to growth finally. The new CFO has a very good background. We've done due diligence on him. Now, from a financial perspective, what you are going to hopefully see over the following 2 to 3 years is accelerating revenue growth. And what is fairly interesting in that acceleration in revenue growth is it's fairly macro and rate agnostic, which diverges from its historical sort of macro inputs across its financial levers. And that is really driven by the securities maturation across its investment portfolio and the reinvestment in higher rates. So they have differentiated fairly structural revenue growth that should be fairly defensive. The second is accelerating KPIs. Their account growth, their net new asset growth, and their activity levels are very high. Tommy just spoke about activity levels from a trading perspective across the exchanges. That is also transpiring across Charles Schwab. And in addition to that, what you have is expanding margins. So they should take their margins from an industry-leading sort of 45% to, I hope, close to 55% over the next 3 to 5 years. And therefore, you have net income growth of sort of north of 12% fairly durably over the next 3 to 5 years. And that should all lead to sort of good EPS growth of over 15% as a result of a buyback tailwind, given the fact that they are currently in an excess capital position, and their excess capital should continue to grow as they have a positive sort of AOCI build, which should permit them to sort of buy back 15 to 20% of their market cap over the next 2 to 3 years. And there are a few other sort of interesting aspects here. The first is a potential modest balance sheet light pivot that the company has sort of hinted at. We think that could provide more excess capital, but also be multiple expansionary. It currently trades at only 16 times 2026 free cash flow or EPS. and that's 10% below its long-term CAPE or through the cycle multiple, which we believe is sort of fair, despite some of the differences in business model pre 2019, and at times when sort of EPS and net income growth started to accelerate to over 20%, the multiple has expanded to over 20 times. And historically, from a bigger picture perspective, this was a large cap core, large cap growth, and even large cap value financial services darling. And it has lost favor with a number of different investment sort of investors over the last 2 to 3 years, just given some of the headwinds that the business has faced. But we see that as potentially turning. And if you look at the cap table, you'll notice that a lot of the largest investors across the investment universe who are active managers don't own the company. So from a technical perspective, there could be the potential for some of those other investors to also warm back up to the name. So we're excited about the fundamentals. We're excited about the new management team. We're excited about and happy about the valuation. We think it's fair. And there are some other technical factors that could help things as well.
Thank you, Cam. Next question, I'm going to throw it over to Ken. We're going to just touch on payment providers. Frank obviously spoke a little bit about the consumer in relation to what banks are saying. I wondered if there was anything you've heard from the payment providers recently in terms of the health of the consumer.
Yeah, absolutely. So we get a lot of questions there, and I think there were a lot of people tuned in to the first quarter calls or first and second quarter calls, hoping that they would hear something from the management teams. Unfortunately, it's a little bit undramatic what they had to say. And I think they reiterated a lot of what Frank said, that the consumer is just awfully resilient. And there's obviously some variance between the bands of consumer. So if you look at it, the affluent consumers are driving the most growth, but that's also consistent with the prior few quarters. There's some sectors that are doing better than others. So if you had to kind of categorize it, restaurants probably pretty stable, retail and fuel is up, travel and entertainment is down. So there are some movements in the underlying bands, but overall the consumer is very resilient. I will say the headline numbers, it looks like there was an acceleration deceleration from I guess like coming into this quarter. But I think people have to remember that first we had leap year in the first quarter of last year. I know that doesn't sound like a big deal, but the difference between 90 and 91 days actually does make a difference when you're looking at a growth rate this year that does not have leap year. The other thing to consider is that Easter fell in the first calendar quarter of last year, whereas Easter falls in the second calendar quarter of this year. And so if you look, those generally speaking had a negative effect, optically at least, on the growth rate year over year in consumer payments. So I do think if you're just looking at the headline numbers and see the decel, those account for the majority of the decel. There was some sluggishness in things like Canada travel, but really beyond that, there's not a whole lot to point to. Now, Visa, MasterCard, the other networks will admit they're coincident indicators. So they're not very good with figuring out what's ahead, but at least what they're seeing right now from the data suggests that the consumer is still very healthy and very resilient.
Thank you very much. I think last question, and then we'll close out for the day, on Progressive. So Cam, an insurance company, it's not often a business you see in growth portfolios. I just wondered if you could talk a little bit there around the growth rate, and also I guess maybe some would question if it's hazardous for an insurance company to sort of follow a growth path. Maybe you could talk a little bit on that.
Yeah. So I would start off by saying Progressive is one of the most unique companies and perhaps best business models that I have seen across virtually any asset class. So they are structurally advantaged, just given the counter positioning that the business has dating back to 1996. So the company made the strategic decision to pivot to a direct-to-consumer model for personal insurance. So that's providing home and auto insurance directly to the consumer. And that's disintermediating what the legacy industry sort of provides, and that is the agent. And generationally, this is where the world is moving. They made significant investments in their direct-to-consumer platform, and they're frankly competing against mutuals. So companies that are less sophisticated invest less in technology, aren't held to public company standards for profitability, but also investment and financials. And so they're sitting at this place in the industry where they are direct to consumer. The rest of the industry is a legacy mutual company that has a captive agent. And over the last 10 to 15 years, there has been a consistent bleed from the agency channel to, broadly speaking, direct to consumer. And that's where Progressive sits. So they are structurally advantaged at the right place in the market. But then on top of that, what they have done over a long period of time is make significant investments in data and analytics. They were the first to introduce telematics. So that is usage-based insurance. So based on driver behavior, they change your insurance policy. And that has been highly predictive and good for their ability to sort of associate risk with a policy and price their policies accurately. So they have an industry-leading pricing advantage as a result of their technology investments on that basis. But in addition to that, they're also, moving from the legacy sort of non-standard market. So that is, a higher risk sort of person that goes direct to consumer, that is a younger generational person, and moving up market to more of the bundled sort of market, which is a very large TAM and growth opportunity for the company. And so they're very well positioned in the market. They're expanding their TAM. And from a growth perspective, to hit on the last sort of point, it is fair and true to raise your eyebrows when an insurance company is growing quickly. The good thing, though, is with Progressive is they are a short tail insurance company and not a long tail sort of insurance company. And so their liabilities reset after 6 months. And so if they do have an issue with associating or pricing risk per policy, they can change rate fairly quickly. And they are also very intelligent about which states they operate in. And so in the United States, insurance is regulated at the state level, which frankly is fairly shocking, but that is the case. It's not federally sort of regulated. And so you have to go to each state regulator and sort of advocate or change your policy. In certain states, that's easier or harder. Progressive is sort of more geared to states where it's easier to change rate and policy. And so if there's an issue with pricing policy, they can quickly move to their state regulator and change that price per policy. And so when you think about businesses within insurance that are growing quickly and that are long tail, that can introduce very significant risk. So if you're pricing, some insurance product that has a 10 or 15-year time horizon, such as, an annuity or long-term care contract, which actually there's no end date, it just, it happens to end when you end. There is significant risk associated with that because there could be, material changes in your investment time horizon or changes in the sort of severity or frequency of what you have to pay for that sort of underlying policy. And so we feel good about their ability to change rate, manage their balance sheet. They're very conservative in how they position their balance sheet. They only invest in treasuries or high quality MBS. They're short duration. So we have a lot of confidence in the growth opportunity, but also how they manage their balance sheet and the risks.
Great. Thank you so much, Cam, and also Frank, Ken, and Tommy. We really appreciate your time. Thank you, everyone, for dialing in. If you do have any questions, please reach out to your Brown Advisory representative. As I mentioned, we'd love to take any feedback. So if you do have a moment, please fill out the box that pops up once you exit the webinar. Otherwise, have a fantastic rest of the day. Thank you very much.